Okay, welcome back. So the Motherson stock is up 3% plus now. Sonia's sort of have been looking at more numbers here, and she's got some margin figure. Sonia.
Yes, the presentation is out, so just quickly reading it out to you. It looks like a good set of numbers actually. On a consolidated basis, the revenues have gone up by 11%, the EBITDA is up by 8%, and they've also given the breakup. The PKC business has done very well, a revenue growth of 12% and a 33% growth that we've seen in the EBITDA for the PKC business. And they've also given us the order book, which is very strong, 19.5 billion euros at the SMR PBV level. So the order book has grown as well this time around. And just to quickly tell you, the margins for SMP have fallen to 1.3% versus 3.8% year on year, but there is a forex element in that as well. Otherwise, the overall consolidated numbers, the EBITDA has improved by about 8% and the profits though have fallen about 17%, but those are in line with estimates. So these seem like a good set of numbers coming in. The standalone business has seen a very strong jump up, a revenue growth of almost about 8% and really, I think what the street is taking heart to is the PKC business, which has grown quite well, and the EBITDA for the SMR business has also grown about 5%. Just a bit of a slip in SMP, but in euro terms there was that forex translation loss that was expected this time around. Otherwise the numbers are looking pretty good, and the big highlight, as I said, is the PKC business, where the EBITDA has grown, one of its subsidiaries, where the EBITDA has grown 33%, coming in at 24 million euros this time around. So this looks like a pretty healthy set of numbers really coming in for Motherson Sumi. No problems at all. A consolidated business overall looking good. Big boost in the standalone business, and SMR also has grown quite well. You could just quibble little bit about the SMP business. That's because of the startup costs that they had for some of their greenfield and brownfield plants that was charged to the P&L this time around.
Okay, all right, Sonia. Thanks very much for that. Well, very well tracked stock as well. Remember, it's down around 32% year to date. So this quarter's numbers were actually looked at very closely for Motherson. Up around 3.5, high point of the day post numbers. Good going for that one. But staying with earnings, it was an operationally good quarter backed by the India steel business for JSPL. Naushad Akhtar Ansari, the CEO, joins in to talk about the business. Thanks very much, Mr. Ansari, for taking the time out. What is the domestic EBITDA per ton in the past quarter, and is it sustainable according to you?
This quarter being a monsoon quarter, we know that in monsoon there are always issues in terms of logistics and so on. And more important, what has also happened in this quarter is that the raw material prices have gone up, whereas the finished product prices have not really kept pace with that. So the impact of, for example, the raw material prices impact was close to about 4,000 rupees per ton, whereas the prices have not gone up by that much. In fact, in some cases it has also a little bit softened. So therefore what has been done well is that the cost has been managed well, the production has been managed well, the ramp up is happening well. So that's how it has been done. And going forward, we certainly expect that we should be able to improve our cost much better than what we are doing today, and therefore the EBITDA per ton should certainly be sustainable. If we really expect it to be substantially higher, something similar to what we had done in the past, maybe much more than what we have in this quarter it is.
What about the sales volume targets for FY19? I think the last time you guided for domestic sales volumes at 6 million tons and Oman at 2 million tons?
Close to that. So Oman will be somewhere close to about 1.9 million, somewhere between around that 1.9 to 2 million ton. And in India, this number will be somewhere close to about 5.8 million or so. So it is very close to what we originally conceived. Obviously, there are we may have marginal shortage, maybe very small amount of shortage compared to what we originally conceived.
Okay. With regards to the Oman EBITDA, it looked good, but has it cooled off in the past quarter? I mean, so 300 million USD still on the cards for FY19?
We do see quite a bit of softening of prices in Oman, especially for the rebar. That's a major product which we have. And that may adversely affect this 300 million projection. It might come down close to about 250 million or so, I'd imagine that, because the prices have come down a bit, quite a bit actually in that part of the world. So, but otherwise, as far as production is concerned, it is doing reasonably well. In the last quarter, we had taken a major shutdown for the DRI, primarily because we have got some additional gas, and in order to utilize that additional natural gas, we needed to make certain modifications in the entire process. So that is how this plant was down for about 30-35 days, and now it is up and running and doing very well. You know, we are producing more than what it was. So just to give you an idea, before that in DRI we were able to make somewhere close to about 180 to 185 tons per hour. With this modification, now we can go up to about 220 or maybe even 225 tons per hour. So now that's the number which will now go up.
Could you talk to us about your debt reduction plan? What has been the reduction we've seen in the last year or so? And by the end of this financial year, what would net debt look like?
You know, there are two parts to it. One is that because of the exchange rate variation, the dollar debt, technically, you know, purely from the reporting point of view, the number will go up, you know, by a few hundred crores or so, simply because of the exchange rate variation. But it has no practical impact, simply because, you know, those repayments anywhere to be done, let's say in Oman or Australia, that is all in dollars terms. So therefore, really there is no impact on the business. But purely from the number point of view, from the reporting point of view, this number will go up. As far as debt is concerned, as we have maintained in the past also, that our debt is totally current. You know, our accounts are absolutely current. There is no outstanding at all. All the debts are serviced properly. The interest payment as well as the repayment, everything is being done in time. And in addition, we are obviously looking at some possible options like monetization. So for example, in Oman, we are looking at maybe either an IPO or some such thing which we had mentioned earlier, and for which we have already engaged with an organization. They are working on it. It will take a few months before we come up with anything specific.
What about the Oman listing? Will it be done this year, this financial year?
Yes, so that's the plan, that Oman IPO we are expecting to do by March in this financial year. So that's the idea, and you know, this debt reduction plan which we had mentioned, we are still holding on to that.
All right, thank you very much for joining us and running us through what it looks like from here on for Jindal Steel and Power. 179 is where the stock is at. We're going to take a very quick break here. We're up 32 points on the Nifty. So it's looking pretty solid. The oil sensitives are doing well. Oil stocks, aviation stocks, paint names, etc., etc. We take a break, and we'll see you on the other side with perspective on Z Entertainment. Stay with us.